Well, howdy there, folks. Welcome into today's video. 4 core subjects to get into in this video here today. First one up here, the number one stock I've been buying recently just reported earnings, okay? We're going to go through those earnings. I'm going to let you know if they're good, bad, my feelings on it, if I'm going to be buying more of this stock, selling it, holding it, things like that. So we'll speak about that right at the front of this video. Then we're going to get into Lululemon. Lululemon warned about the U.S. consumer, a massive, epic slowdown at the front of the year here, and we'll speak about, is this Lulu specific, or is this like something bigger going on? Are we going to go into recession? If Lululemon's saying the consumer is all of a sudden pulling back massively, is that a recession sign? Okay, FedEx stock is skyrocketing to all-time highs right now. Their earnings came out about an hour ago. We're going to go through the numbers and really talk about, is it as good as it seems, or is it a little bit of a mirage or something like that, right? Because we do know FedEx, usually if earnings are great, that means the economy is usually good. Is that the situation here? We'll get into the earnings and find that out, okay? And the last thing we're getting into is in regards to PayPal. So if you didn't see, the Department of Justice is now going after Apple, and this has ramifications for PayPal and for Meta as well as a ton of other companies. So we'll speak about that and go through that in this video, but more so in regards to PayPal specifically, okay? Appreciate you guys joining me. As always, all I ask in return is lightly tap that like button. Lightly tap it. Don't smash it too hard. I don't want anybody breaking their Monopoly screen. I mean their iPhone screen, okay? Just lightly tap it. Make sure you're subscribed here to the channel. If you're looking to apply to join my private group, then you can go ahead and do so. That will be pinned comment down there. Some would say I have a monopoly on the amount of people hitting 6 figures and 7 figures in the market. I feel like, it's fair play, okay? All right, guys, let's get into this. First up here, number one stock I'm buying, just reported what's going on here, okay? So this particular stock I've been buying pretty aggressively here recently. So right here was my first buy in the public count here. This was December 28th, 2023. So right before New Year's, I bought 100 shares there, 5 shares, 10 shares, 185 shares I bought right here on January 17th, then 5 shares, 13 shares, 4 shares, 8 shares, 8 shares, 5 shares. And I've also been buying the stock very actively recently in the Patreon portfolio as well, and I do own it in another account, okay? So what stock is this? It rhymes with pikey. It is Nike. Okay, Nike stock. So Nike stock, I'm up to 343 shares in the public count, $34,000 plus in the stock, and this has been a stock I've been wanting to buy. So the earnings came out, the stock's up 4% plus after hours here. Now, in regards to the actual numbers, they're not good. They're not good. I gave them a D income statement here overall. Whenever I look at income statements, I always just look at it unbiased, whether I have a short position in that stock, long position, or no position. I just call it the way I see it. And I do that for all my stocks and all stocks in general. And so Nike, this was a D income statement here. Revenues didn't grow for the company, right? Well, technically they did, but really no growth. Cost of sales was down about 2%, so that was good, right? Gross profit was up 4%, so that was good. Gross margin went up to 44.8%, so that was good. But demand creation expense went to 10% up year over year. Operating overhead expense was up 6% year over year. Now, you want to compare these numbers to revenue, right? And so if your revenue's at basically no growth and your demand creation expense is up 10%, overhead expense of 6%, total selling general administrative expense of 7%, that's not good news. You don't want to see those way outpacing your revenue growth overall. So as far as those climbed to 34%. That's not good there as a percent of revenue, right? Income before income taxes was down 5%. Net income for the company was down 5% year over year for Nike. So not obviously an impressive income statement at all out of Nike, which doesn't come as a surprise to me really at all in regards to that. Now you'll see a lot about Nike beat their earnings, what analysts were expecting and things like that. And it's always cool to see if a company beat earnings or missed earnings, but what the actual numbers are matter more than if they beat or missed analyst estimates, okay? Now, in regards to Nike, right, you might say, okay, why would you own a stock that, is reporting a D income statement here at the moment, right? Or at least what I would grade as a D income statement. The reason being is I'm in the stock for the future, right? I'm buying the stock now because I believe the story is going to get a lot better over the next couple of years here. And so we're in their fiscal year right now. Their fiscal year ends at a very weird time. It ends in May of 2024, right? And then starts a new fiscal year. So right now they're doing a lot of cost-cutting measures and those sorts of things, and those are going to be going over effect in the next several quarters here. But as far as the following year, I think their EPS is going to be much higher than where analysts are at for this company overall. Now, I was watching some Fast Money earlier. They were talking about competition. They were talking about, Hoka. They were talking about On and these sorts of shoe companies that have come out of nowhere the last 2 or 3 years and are like competitive threats to Nike, right? And the thing I'll say overall in regards to that kind of thought process is these companies come and go. Allbirds is nearly bankrupt now at this point in time. Allbirds was taken off like crazy just a few years ago, and the stock's down to 74 cents. Don't be surprised if you hear a bankruptcy coming for Allbirds in the next year. We'll see what happens there, but it's not looking good for them, right? Under Armour stock is down 64% in the past 5 years. It's all the way down to $7 a share. Things have gotten so bad at Under Armour that the founder of the company, Kevin Plank, is returning as CEO because the company's in such a bad spot now at this point in time, right? And so the important thing to understand about the clothing industry is, did you ever hear what Elon Musk said in the past? Elon Musk has said in the past, Tesla and Ford are the only car makers in the United States that haven't gone bankrupt. And I don't know, he might be right about that. He might be right about that. I guess he's probably right about that, right? And so, like the auto industry, it's hard to make it, right? And it's hard not to go bankrupt. Same exact thing in the clothing space. It's very, very difficult. You can come out and you can be a popular brand for 5, 10, 15 years, and then next thing you know, all of a sudden you're not as relevant, you're facing bankruptcy, you have to be acquired by another company or something like that, right? Nike's really the only company in this whole entire space that can make it through decade after decade, generation after generation, right? The 1980s, 1990s, 2000s, 2010s, 2020s, it's a very special company. When you can make it through decade after decade, several generations, that's Nike at the end of the day, and there's very few that can do that. So am I going to be buying more Nike shares? And the answer is likely yes. I will likely continue to acquire Nike shares as just a great long-term company to own. Overall, I love the diversification it adds to my portfolio. Let's talk about Lululemon. They give a big warning in regards to the U.S. consumer. Then we'll get into FedEx, what that means for the economy, and then PayPal, Meta, all those sorts of things, okay? So Lululemon's crashing after hours. It's down double-digit percentage, down over 10% after hours here for Lululemon. Now, in regards to Lululemon, the bad news, the very bad news, is sales in North America rose 9% compared to 29% increase in a year ago period. So there's some sort of massive epic deceleration going on in North America for the company right now, which is not good to see. Because when you go from 29% growth to 9% growth in 1 year, now people are going to be like, what's growth at this time next year? 3%, 4%, 0%? Are we going to go negative? Could revenues go down year over year by this point next year? People start getting very, very concerned. Now, Lululemon said, as you heard from others in our industry, there's been a big shift in the U.S. consumer behavior of late. And we're navigating what has been a slower start to the year in this market. Now, that's basically saying bad numbers are coming, right? Oh, you thought these numbers were bad, just wait till later in the year. You're going to see really bad numbers. That's my interpretation of kind of what they're saying there. They're basically prepping up investors in Wall Street for likely bad numbers coming over the next couple quarters here, right? But they're kind of blaming it on you. They're blaming it more on U.S. consumer than something that they can control, right? So that's a little strange overall. I don't know. Here's the deal, okay? Lululemon, it was just back in January, they had raised their holiday outlook. Lululemon raised their fiscal fourth quarter outlook. I don't know, man. Things like change pretty rapidly in regards to Lulu there. Is it really the consumer, or is there something going on with Lulu? If we look at their income statement, they're phenomenal. It's an A- income statement here. It's absolutely amazing. Revenues, $3.2 billion versus $2.7. Cost of goods sold, they kept that in check. Very nice. Gross profit went to $1.9 billion from $1.5. Now 59.4% as a percent of gross profit of revenue. That's incredible, right? Incredible numbers for gross profit. If you look at selling general administrative expenses, that was up year over year for the company, so that's kind of bad. Now, last year they had a one-off here. If you look at impairment of goodwill and other assets, restructuring costs, it was $407 million. So it was an epic one-off. So it makes their profitability look like it was skyrocketing this year. And it's good numbers, but it's not as epic as it seems, because if you have a one-off $407 million expense last year, it's pretty self-explanatory, right? Income from operations went up to $913 million. That was about 28.5% as a percent of revenue. That's an incredible number. Net income, $669 million. And basic EPS, $5.30. Diluted EPS, $5.29. So very good numbers. But I think Lulu's getting themselves in some trouble here. Okay, let me explain. So the company, if I went to their front page here, and they're trying to push into shoes. right? We just spoke about the shoe market just a minute ago, right? Athletic shoes, Nike's the big dog there. And then you've got a lot of upstarts like On, Hoka, and maybe another company or two, right, that are there. And then you got Lululemon trying to come in this space. And it might seem like, oh, this is just great. You know, so many people buy shoes. This is a great opportunity for Lululemon. Could be. It also might be a huge money-losing business. You might say, well, how are they going to lose money on this? They're probably going to sell those shoes for $100, and you know they make them for $30 or whatever, $20, maybe less than that if you cost. You know, you factor in the shipping fees and all those sorts of things. Well, the big thing you got to take into account is you got to spend a lot of money on marketing if you want to sell your shoes, right? It also needs shelf space in your actual physical stores. You need to put promotional activities behind that, which all cost money, which can then, if your sales volume is not high enough, you can actually lose money. And I know it's hard to believe, you know, when you're making shoes for cheap prices and you're selling them for expensive prices, you could actually lose money because of all the marketing you spend there. I scrolled down a little further on the page and, you know, they were selling dresses and these zip hoodies and these sorts of things. And so I don't know where Lulu's taken their brand or what they're trying to do here, but it seems like they're, I don't know, it's seeming to me like they might be getting a little bit lost here at this point in time, right? Now, the main issue for Lulu in regards to stock is that when these earnings priced to perfection, you know, when you're trading at 30 plus, you're a clothing company trading at 30 plus PEs, you're kind of priced to perfection, especially when everything in your business is already going great. It's not like a Nike situation where, you know, Nike's been going through some trouble here over the past year or two, right? And yet Nike trades at a forward P in the 20s. Lulu, it's kind of like everything's been going great for them and they're trading at a forward P in the 30s. So they were praised to perfection going into this. So any little thing that went wrong, the stock was ready to go down in quite a substantial way, right? And I spoke about Chipotle stock in last night's video. That's another one of those stocks that if anything goes wrong, you'll see it drop, you know, double-digit percentages there. So in regards to Lulu, do I look at this and am I scared about U.S. recession based upon what Lululemon said here? I'll say this, okay? First off, who's Lululemon's demographic? Lulu's demographic is a lot of folks that are, you know, at the lowest middle class, but a lot of upper middle class folks, right? A lot of folks that have incomes $80,000 plus per year, right? A lot of household incomes $100,000 plus per year. So I haven't seen those consumers necessarily pull back in other spaces yet. Could happen. But I haven't seen pullback yet in other spaces that would make me say, oh yeah, U.S. consumer is really bad right now. I've seen too many companies come through with really strong earnings this year, right? And even a Nike, this was expected to be a bad quarter, you know, it came in better than Wall Street had expected. So when I look at it from that angle, I see a Lululemon here that there might be actual fundamental issues going on with Lululemon's business model. And so I don't want to just chalk it up as, oh, the consumer is bad right now or something like that, okay? So that's kind of my view there. We'll see where this goes over this year in regards to Lululemon. I think it's a big year for Lululemon to really show that they can get through this and make it out to the other side and, you know, keep these big growth rates going. Because, yeah, when you go from 29% to 9%, where are you going next? 4%, 3%, 2%, right? FedEx. So FedEx stock, and then we'll get into PayPal, Meta, and all those sorts of things. FedEx stock's skyrocketing. It's up like 13% after hours. It should be hitting all-time highs tomorrow, maybe pushing 300 plus. Now, whenever FedEx stock is skyrocketing, usually it means good things for the economy. It usually means you're in a good economy. You know, people are excited about the economy over the next couple of years. And the same thing with UPS. And the reason these sorts of companies kind of skyrocket and everybody views it as a good economy is because they're shipping packages really all over the world, but especially over the United States of America, right? And so it makes everybody kind of feel good. But are things really that good or not? Okay, so you have to dive in the numbers here and see what's actually going on. And we're going to find things are different than maybe the stock price is saying, okay? Revenues were down 2% year over year for the company. That's not good. No, okay? I mean, you know, a company like FedEx should really never have revenues going down unless you're in a big recession, right? So that's not good. Now, if you look here, total operating expenses was down 3% year over year, which really helped their operating income and helped their net income look like it was up huge year over year, right? But they got bailed out. Bottom line, look at the fuel expense. Fuel expense was down 16% year over year. There was a $210 million difference in fuel expense, right? So if fuel expense was not a $210 million benefit, this quarter would not have been nearly as good when it came to operating income and when it came to net income, right? And technically, they could have actually had their operating income and net income down year over year if that fuel expense help there was not there. So when I look at this, what I see is this does not seem like necessarily a booming economy for FedEx. This seems like things are on the weaker side. If your revenues are down 2% as a company like FedEx, that's not good. And the scary part of this is, the very scary part is, if we get a big bull run in, let's say, oil price this summer, and that affects gas prices, right? Well, then we could see a company like FedEx, their earnings actually starting to drop year over year. So that's just a little food for thought in regards to that, okay? Now, if oil prices stay low all summer, then FedEx should be looking good. But the moment oil price starts going up, gas prices are going to start going up, fuel expense starts going up a bunch for FedEx, and that leads to earnings that could then also be trending down year over year, right? Now, is FedEx a buy or not a buy? Well, I was looking at kind of their guidance here, right? And they're talking about earnings per share, $17.25 to $18.25. So I thought about it like this. I said, okay, let's say they do $18 of EPS this year. Let's go a little bit on the high side in this situation, right? So FedEx usually trades somewhere between a 12 and 14, especially when the stock's doing really well, 12 and 14 times, somewhere around there, right? So let's say you slap 12 times, a 12 PE on the stock, $18, let's say they do, you're at a $216 stock price. Now, the reason you're never going to command a massive forward PE on a stock like FedEx is it's very cyclical, right? It's up and a down business. It's kind of like home builders. It's kind of like traditional auto manufacturers like Ford and GM, not quite that bad in terms of how people evaluate it, but it's not seen as it's not NVIDIA. It's not tech companies. It's not a Palantir. So they never trade at rich PE ratios. So 14 is pretty fair for FedEx overall. If let's say they do $18 of EPS at a 14 PE, that'd be fair price of about $240 for the stock. So fair price, I would say, for FedEx stock right now is somewhere between $216 and $240. That's fair price. I wouldn't call it undervalued. I'd call that fair. The issue is the stock's pushing like 300, right? So as of now, I would say FedEx is now an overvalued stock, and there's limited upside, if any upside, in FedEx left at this point in time. If there's any upside, it's very limited. And the further the stock goes, the harder it will come crashing down when things start to weaken a little bit. And it can weaken two ways. One is the economy gets worse at some point in time in the future, right? Let's say the economy gets better, but then fuel price goes up. That's the risk, right? If the economy comes in hot, and let's say everybody gets very bullish on the economy, and well, then suddenly oil prices start to go up substantially as well, right? Which then leads you to obviously a bad situation for fuel prices, and that could be very detrimental to FedEx. So there's a couple ways you could get the stock down. Now, is this something I want to buy put options on to hedge? No, not FedEx. No, not interested in that. But I'm just going to say there's limited upside in the stock for the next few years, in my personal opinion, when I kind of look at what's going on here. The best time to buy FedEx stock, and the time it's usually easy money, is when you're in a recession or you're going through a period where there's a lot of fear of recession. So if we go back, great financial crisis, obviously great opportunity to buy FedEx stock. Stock was down to $40, $50 a share in that whole situation, right? Then around here, you had the double dip recession fears. That was a tremendous opportunity to buy FedEx stock. Stock was down under $70 a share. Rona, right here, stock got down to $120 or so in that. And then the 2022 crash, obviously a lot of fear about recession. We know what it was in 2022, right? And stock got down to about $150 a share there. So just keep that in mind for the future in regards to FedEx. If we're ever going through a recession or if there's a massive, epic amount of fear of recession, it's usually a good time to buy FedEx stock. And when everything looks great and everybody's bullish and all-time highs in the stock market, usually that's the time you want to avoid a stock like FedEx. So that's just a little food for thought in regards to that one, okay? Now, Apple, Department of Justice, all those sorts of things. How's it all play out for PayPal? How's it all play out for Meta in situations like that, right? First off, PayPal, congrats to shareholders out there. We're finally moving up in the right direction. I just reached a 5-figure club in PayPal stock. It's up over $10,000 now at this point in time, up $11,338. Hopefully a lot more gains coming over time. And that made me think, 5-figure club. If you didn't know, when you're in the Patreon, you got more than 5 figures in your portfolio, you can apply and we'll ship you to one of these awards to your house. If you're in the private stoic group, we got the 6-figure club, diamond award, and then we got big dog, 7-figure club award, $1 million plus. Plus you get your membership cards there. So once again, if you're looking to join a private group, pin comment down there. If you're looking to join my Patreon, that is going to be in the description area down there, okay? Department of Justice sues Apple over iPhone monopoly in landmark antitrust case. The Justice Department sued Apple in an antitrust case, saying the iPhone maker has a monopoly over the phone market that's harmed consumers, developers, and rival companies. Apple's ecosystem, from Apple Watch to Apple Pay, supports that monopoly, prosecutors said. The challenge strikes at the core of Apple's walled garden model. Now, before we go further here, let me say this, okay, because I listened to the entire speech and the question and answer session the Department of Justice gave today and the Attorney Generals for the different states, okay? Listen, they got a lot of dirt on Apple. They have emails even going back to Steve Jobs' days. That was a long time ago, okay? And they got a lot of emails that do not portray Apple in the best light and make it seem like Apple's making specific moves to basically, stifle competition, okay? So I would say, based upon the emails I heard, and I'm sure they got so much more dirt than what they gave out there today, they got a lot of dirt. They also likely had dirt from Google, from Meta, because of what the government years ago went after Meta. Obviously, they went after Google. I'm sure they got a lot of dirt there in regards to Apple. I'm sure they've been collecting a lot of dirt on Apple for years now at this point in time. Epic Games, Spotify. So, and who knows if they got a whistleblower or two in Apple. All I'm going to say is they got a lot of dirt across the board on good old Apple, okay? So that's that. The Department of Justice sued Apple on Thursday, saying its iPhone ecosystem is a monopoly that drove its, quote, astronomical valuation at the expense of consumers, developers, and rival phone makers. The government has not ruled out breaking up one of the largest companies in the world, with a Justice Department official saying in a briefing call that structural relief was on the table if U.S. were to win. I don't see that happening. I don't see them breaking up Apple. I think they're going to force changes at Apple, but I don't see necessarily a breakup of the company. I think that's more tough talk of like how bad it could really get for Apple. I think that'd be like worst case scenario. That's pretty far-fetched, but you never know. The Justice Department said in a release that to keep consumers buying iPhones, Apple moved to block cross-platform messaging apps, limiting third-party wallet and smartphone compatibility, and disrupted non-app store programs and cloud streaming services. And as an Apple customer, we all know that. I'm just going to be honest. We all know Apple, has screwed up messaging for the last 10 plus years, and it makes it impossible for you to, we know what it is. I don't even need to explain it to you. If you have an iPhone, you know exactly what I'm talking about. But this is an important part. Limited third-party wallet. Department of Justice says Apple's complete control over tap-to-pay transactions stops innovation and cements its monopoly. In a wide-ranging antitrust complaint against Apple and the iPhone business, the U.S. Justice Department takes specific aim against Apple's massive financial business, specifically how it uses Apple Pay to block competition and make billions of dollars a year in the process. The Department of Justice alleges that Apple is not only stifling competition among payment services, but it is also potentially stifling innovation, since the fees that banks and others fork out to play with Apple Pay make them less inclined to develop other kinds of services that might rival Apple. It's very important. Apple Pay is no stranger to regulatory controversy. In 2020, the EU opened an antitrust investigation into it. And in January 2024, perhaps with a sober regard of the other looming regulatory battles it would be facing this year, Apple finally offered some concessions where it would allow third parties to access its NFC and related technology to build their own tap-to-pay payment services to bypass Apple Wallet and Apple Pay. PayPal, the payments behemoth that has substantial businesses in mobile transactions and point-of-sale technology, was apparently instrumental, so they got stuff from PayPal as well, instrumental in the original EU complaint around Apple's payment monopoly. Contacted today about the DOJ complaint in the U.S., a spokesperson for PayPal said the company declined to comment. It's certainly keeping a close eye on proceedings. The Department of Justice argument. Apple today takes a 0.15% fee on any transaction made via Apple Pay. In 2021, that worked out to about $1 billion. By 2022, that grew to $1.9 billion. And in 2023, it's estimated that the figure more than doubled to $4 billion. Pouring in for Apple now at this point in time from this, right? That's incredible. Absolutely incredible. Now, it's very convenient and interesting that on March 7th, right, just a few weeks ago, PayPal was finally able to open iPhone Tap to Pay for Venmo business users, right? Which kind of feels like Apple knew what was coming here, right? They must have known. Because the fact that all of a sudden all this happens right before the DOJ drops this, that's a little suspicious, right? Now, for Apple, the next 2 to 4 years, they got to be on their very best behavior. Now, this is going to drag out. This is not something that's figured out tomorrow, or next week, or next month, okay? Something like this is going to take years. Minimum 2 years, in my opinion, but could take up to 4 years, okay? So Apple's going to have to be on their best behavior for a while. And I've watched Apple, I've watched what Apple's done with Meta over the years. I've watched what they've done with PayPal over the years. I've watched what they've done with Spotify over the years. I watched what they did with Epic Games over the years, right? Meta encourages advertisers to ditch iPhone in the latest spat with Apple. This was back from February, last month. Advertisers are steered to a workaround to avoid paying a 30% service charge to Apple for boosted posts. So basically, Apple, if you want to boost your post on, I guess, Facebook or whatever, you have to pay a 30% service charge to Apple, even though you're doing it through Meta, right? Even though you're doing it through Facebook. So this is how wide-ranging this got, and this is where I think Apple's really screwed up in a big way. They've gotten too greedy with it. There's like a fine line of like what they could have gotten away with versus like taking it so far where now you want a 30% service charge for people boosting a post on Facebook? What? Like, it's just ridiculous. So that's how far Apple's gone at this point in time, and I think their greed's probably gotten the best of them in this situation and cooking the whole team, right? Now, this is also good news for Meta overall, because I think Meta's got it made for the next 2+ years. And the reason they got it made is because it's kind of like, you ever have a police car behind you while you're driving? Suddenly you start driving extra careful. You're watching your speed limit extra good. You're like, I don't want to give them any reason to pull me over. I want to make sure I fully stop at this light here. I'm not going to do a California turn. I'm going to fully stop at my red light, make sure it's good. Then I'll proceed very cautiously. You start being a little more concerned. This is the same thing with Apple now. This is going to go on, like I said, for the next 2 to 4 years in my estimation, okay? So during this time period, Apple's got to be on their best behavior because the police officer's right behind them at this point in time. And they're watching every single thing that they're going to do now. So Apple cannot really do much of anything that is going to be seen as a negative to other companies, especially in regards to the services regards specific. Apple's going to continue to come out with new phones and new iPads and new Macs and all those sorts of things over the next 2 to 4 years, but they're not going to be able to do anything like they've been doing, which is a lot of sketchy stuff. The messages, we all know about that, right? The payments related stuff, blocking other companies from using this, taking 30% fees for if you want to boost your post on Facebook. Are you kidding me? Like all these different things, they got to cut that out because the police officer's right on their tail right now. They're in the rear view mirror. And if they do anything wrong, it's, coming to light now at this point in time. So that bodes well for a lot of companies. It's not just PayPal and it's not just Meta. It's a lot of companies now at this point in time, folks. So we'll see where it all goes. But it's Apple's going to spend a lot on lawyer fees in this situation. I can tell you that much. A lot. It's going to be a lot. And I think they're going to have to make changes with payments. I think they'll have to make changes with messaging. I don't know if they got to make that many changes after that, but I think those are two things that are kind of slam dunks for the DOJ, and then we'll see where things go from there, okay? All right, guys, appreciate you joining me. Much love as always. If you're looking to join my private group and fill out an application, pin comment down there. You can go ahead and do that. Much love and have a great day.